In this lecture, we are going to model the three different options. So if you recall the house example, we had an at the money option at 1 million, which we said was equivalent to the 470 strike price on Apple. And we had an out of the money option, which was at $1.1 million in the case of the house. And we said in the case of Apple, that would be equivalent to the 510 call. And we also had an in the money option, which was at $800,000. And in the case of Apple, we are looking at the 425 strike price option. So let me put it back to the last traded value. And now what we want to do is to look at the risk and reward profiles of all of these. And so the first thing I'm going to do is look at the at the money options. So we know that it's going for about $15.40. So if we wanted to buy 10 contracts of this option, we click on the ask price and the platform will automatically put up an order screen for you. Here we are looking at a single option. It's a single option because it's not a spread. It doesn't involve more than one option. We are buying this option. We are buying 10 contracts. So that's like equivalent of 1,000 shares of Apple. We are buying it in the March 2013 series. We are buying it at the 470 call strike price. It's a call option as opposed to a put option. And we are going to pay approximately $15.45 for this option. Now, if you're buying 10 contracts, which is 1,000 shares, you have to multiply that 1,000 by $15.45. And that's going to be your total outlay for this trade. So that's going to be $15,450. Now, if you were to buy 1,000 shares of Apple, the stock itself, you're looking at putting down about $467,000. So you can see that this is just a very small percentage of what you would pay for actually buying the shares. Now, I want to show you a couple of things. Here, when in the last column, you'll see a column called the BP effect, and that is your buying power. Now, the broker is going to hold $15,450 for this particular trade from your account. Now, why did he do that? Because you're paying $15.45 per share, and for 1,000 shares, it's going to be $15,450. And when you're buying options, if you remember from the first section, we said that your maximum loss in this position is going to be $15,450, whereas your profits on the upside, if Apple were to continue to go on the upside, it is unlimited. And so that's what we want to see in this lecture. So on the Thinkorswim platform, you can click on this risk profile here, and it will show you the risk profile of this particular position. So the first thing we see here is that we have a horizontal line at the 470 level. So from 470 onwards, the line is flat. It's parallel to the x-axis. You'll need to think about the slide that we covered in the first section where we had the buyer's risk graph. And we said your risk for a buyer is limited to what they pay for the option, limited to the premium that was paid for this option. And that's exactly what this is. You can see this red number here. On March 16th, which is 30 days away, the maximum that this position can lose is the negative 15,450. It doesn't matter if Apple goes to 430. It doesn't matter if it goes to 400 or 300 or 200. It doesn't matter. Your maximum loss on this position is going to be 15,450. However, on the plus side, anything above 470, and then you're going to have to add the premium that you paid. So 470 plus 15 is about 485, and you can see this vertical red line here, and that should be approximately at 485. So 485 is your break even. This is the zero line here. And you have Apple prices on the x-axis, and you have your profit and loss on the y-axis, just like we saw in the earlier slide. And anything above 485, you can see that this red line goes into the positive profit zone. So if Apple were to go to 510 or 530, you're looking at a very serious profit here. And that's because if it makes a big move, you as the call buyer are going to benefit in the upside. So there is unlimited profits on the upside, and on the downside, there is limited losses. However, if you buy this option right now at the 470 call, bear in mind Apple is at 467. So you do have the burden of movement in the next 35 days all the way up to 485. And your position will only profit if it goes beyond that level. Next, we are going to look at an out-of-the-money option. The out-of-the-money option we looked at was 510. So you can see now the gap between where Apple is and your break-even is about $18 or so. Now, when we look at the out-of-the-money, it'll become clearer why the probability of this out-of-the-money option is much less. So all we need to do is, if we wanted to select the out-of-the-money option, I'm going to come here and select the 510 call. Immediately, you can see that the platform changes the price. Now you're going to pay only $3.85 for this call option. And if we look at the buying power effect for 1,000 shares, it's going to be 3,850. And that's what the broker is going to hold from your account. So let's now look at this option in a little bit more detail. Now you can see that this horizontal line represents a maximum loss of 3,850. But look what it did to your break-even point. So Apple's currently right here at $467. But now, because you bought the 510, you're going to see a horizontal line all the way till 510. So on the day of expiry, if Apple is below 510, you're going to see the maximum loss on this position. And then beyond 510, Apple will need to move up by an amount equal to the premium that you paid, in which case, in our case, it's $3.85. So our break even is at 513, almost 514. And that's the problem with the out-of-the-money options. You can see that the distance between where Apple is right now and the distance to break even has become really large. But once you get there, and if it goes above, you're going to see that the return on your out-of-the-money options are going to be much more than the other kinds of options. And that's because you're paying so less for this option. You're paying only $3.85. And if Apple were to move from 467 to 510 or 520, you're going to see that the $3.85 cent option is now worth perhaps $10 or $11. So you're looking at a 200%, 300% return if this option becomes successful. But you have to balance that out against the probability of that option doing that. And that's what the whole entire options game is all about. It's all about choosing your strike prices, looking at the probability and how much you pay for the option. All of these considerations go into choosing an options position. So this is all strategy. It's complete strategy. And behind the strategy, there is a lot of math. So you will have to understand all the math behind it. But once you do, you can create appropriate strategies using the right options. So now perhaps you have a better appreciation of the differences between stocks and options, because in stocks, there's really no analysis. You either buy or you sell. If you buy and the stock goes up, you make money. If it goes against what your expectation was, in both cases, you're going to lose money in stocks. That's it. Whereas in options, that's not the case. There's a lot of strategy here. There's a lot of math here. So this was the out of the money call. Now, the last example we're going to take is the in the money option. And if you recall, our in the money option was at 425. So I'm going to select the 425 call. We are going to pay a whole lot more for this option. We're going to pay $46.30 per share. So for 1,000 shares, it would be 46,000. And that's going to be your maximum loss for this option. But look what has happened to your uh, profit and loss diagram and your break evens. Now, Apple's right here. Where is your break even point? Your break even point is right here. How did it come so close? That's because your break even point is determined by the strike price, which is at 425 right here, plus the $46 that you paid. So 425 plus 46 comes to around 470 something, 471, whereas Apple is at 467. So in your in the money option, you're going to see that you're very close to your break even. So it has the highest chances of success, but you're going to pay a lot more for your in the money option. For your in the money option to see a maximum loss, Apple has to go down to 425 and below 425. That's the only time you're going to see this maximum loss. But if Apple goes down, you're going to see a loss on your in the money option as well. But the fact that you're buying in the money option means that you're bullish and you expect it to go up. And by buying an in the money option, you're giving yourself the best chance of making a profitable trade. However, I should also tell you that many times you don't buy in the money options because you'll realize that these options move very fast. And those are things that are dictated by the Greeks, which again are covered in a later course. So don't think that you have to buy in the money options. That's not the case. In fact, many people buy at the money or out of the money options because the return on those options are much more, and the cost of those options are much less. So it makes sense to buy at the money or out of the money options. But you have to put the right strategy in place. You have to select the right expiry series, and then you have to select the right option. So that's as far as the profit and loss diagrams for the three kinds of options that we've considered.